I'm curious, and I don't know how often you currently deal with vacant land deals, but I know it's something that I've dabbled with a little bit, and I know a lot of other land investors do this, mainly because I think it's out of desperation, honestly. They'll have a really cheap piece of land, maybe it's $5,000 or $10,000. It's not the most desirable property, but they offer seller financing because they know it's going to help the thing sell faster. More people can get access to it. But when you're talking about a deal that small, where payments coming in are like less than $100 a month, the economics of the deal start to get messed up. It's like, is it worth paying $650? And like, is it worth just dealing with all this hassle versus just getting paid cash? Yeah, I'm just wondering, like, of the land deals you see, or even house deals, do you ever notice like a minimum? Like, people typically don't come to us if the deal is less than X number of dollars.
Yeah.
Like, as a land investor, like if I see a deal that's below 10 grand, like, should I just not even do it? Like, just make them pay cash or
well,
what do you think?
No, because see what it would come down to is you screening properly, right? So you sit down with the borrower and say, I'm selling this on owner financing, and it would entail a loan origination expense for you because we have to vet you in some fashion. But we're willing to work with you on this when a bank wouldn't. And so here's the deal, you know, it's going to add $679 to your purchase price. Are you willing to do that in order to have our guy work with you? That's just how that works. And then it gets wrapped into their deal. So, you know, we don't do a ton of small deals, but they could still make sense from the investor standpoint because you're not bearing the expense. And they always make sense from our standpoint because it's the same amount of work for us. If it's a $4 deal or a $600,000 deal, it's the same amount of work. And so, $679, we don't care how big the deal is.
Yeah. Is that pretty much what everybody else does? They just pass it on to the borrower. Does a seller ever bear that cost on their own, or is it?
Yeah, there are a few sellers in seller finance that they have a business model where they're basically helping nearly indigent people. And so they're giving them like a no strings attached loan saying, if you can qualify for their underwriting, we'll eat the underwrite, we'll pay it ourselves. I have several people that do it, and they're doing lots of deals, and their profit is in the down payment and holding that note at 10% or 12%. And so, they'll eat all closing costs. I just did one last week, and they said, we'll cover all closing costs, so don't even list the closing costs on the disclosures to the borrowers. We're paying them all. Because think about it, if you're selling somebody a $275,000 house at 10% interest, and you've already put a markup on it anyway, right? You got the house cheaper than you're reselling it, so you got a markup on the house, and you're getting 10% interest on it, and you're getting a $25,000 down payment from them. What do you care if you eat $679 up front? It's nothing. It's a drop in the bucket.
I know a lot of states have like a maximum interest rate that can be charged on a seller finance deal. Does that also apply to vacant land, or is vacant land exempt from that in some way?
That you will definitely have to check individual state by state. I specialize in federal compliance. And in Dodd-Frank and federally, there's no max interest rate you can charge. You can charge 90% interest if your borrower can still meet all the elements of ability to repay. But there absolutely, state usury laws differ from state to state. And so anytime you're making a state-specific transaction, you want to be aware of what your specific state usury limits are and make sure you're within those.
Do you know, is there one place you can go to check what that is? State by state, or do you just Google state usury laws or something?
Yeah, if you just Google in New Jersey state usury laws, they'll come right up.
Okay,
but it's not a sexy read, I promise you. And so for me to try to know all 50 when I'm dealing with deals in all 50 states is just, you know, I've got a huge head, but it's a tiny brain. So yeah, there's no way I could do that.
Okay, gotcha. No, that's good to know. For properties where Dodd-Frank compliance is required, what are the consequences for not being compliant? Like, say if you just totally ignore it, just do what you want. I guess who would catch you? And then if they did catch you, what would happen to you?
Great question. So the CFPB, the Consumer Financial Protection Bureau, the CFPB is the teeth that enforce Dodd-Frank. They're a massive entity that is all about curbing, regulating, stopping predatory lending, and the CFPB can levy fines up to and including $25,000 per violation per transaction. In some cases, I've even seen them award the asset to the borrower. In other words, in court, say this poor borrower, this mother and 6 children, was lured out of their safe government housing on the promise of this home. It was predatory. It didn't meet the elements of Dodd-Frank, and we're now awarding the asset free and clear to this poor mom and her 6 kids. And we're going to take the asset from the lender. We're going to slap multiple $25,000 fines on the lender, and possibly even issue a state cease and desist order on that lender. So the fines and penalties are enormous.
Yeah, I mean, they got destroyed. You
could have 50 violations in one file. So when I say it's up to and including $25,000 per violation, I don't mean $25,000 per loan. I mean, if you failed to disclose this, that's a $25,000 fine. You didn't do this right, that's a $25,000 fine. They could hit you with 50 of them in one file. So it's a huge issue. So we help produce files that transparently demonstrate our regard for Dodd-Frank and fair lending. And so when you're holding a note that we underwrote, you're holding a file that you can confidently lay out on the table and say, here you go. You want to see what my business practices are? Here they are. And it will reek of regard and respect and concern for all the elements of Dodd-Frank and ensuring that you do not appear to be a predatory lender.
Yeah, it sounds like a good use of $679 to be able to
that
check
your
those
borrower
boxes.
paid for anyway. See, that's what's so silly about it, right? Your borrower at the end of the day is still the one eating that fee, and that's legal to do. You can't charge them for it up front, but you can wrap it into their loan. And so when they're paying for it anyway, why wouldn't you be as safe and conscientious and complex with your underwriting as possible when your borrower's paying for that service anyway?
Kind of going back to the underwriting stuff, whether you're doing it or a person's trying to do this on their own, just like principles of it. So like, what would be a big red flag or even a small one that should make you run away from a potential borrower?
Yep. Yeah, great question. 2-year work history right off the bat. I'd start every talk with, tell me about your last 2 years of earning. Do you have, can you document your last 2 years of income? And were you making as good a money 2 years ago as you're making now, or has it been a steady increase? When you get that person that hems and haws and says, well, I didn't actually work in 2021 because of COVID. And then I started with Walmart, but I didn't like them and I quit. And now I went to Target and I'm thinking about quitting them and going to Best Buy. When you start getting that, run, because you'll next to never get that person qualified because they don't have a good, strong history of waking up and going to work every day. So the flavor you're looking for with a borrower, more than the specifics, is you're looking for this steady Eddie that wakes up and goes to work every day and earns steady money, and they earn steady money in 2021, and they earn steady money in 2020, and they earn steady money in 2019, and they're eager to prove it to you, and they can slap a pile of W-2s on you that show that every single day they get up and go to work. When it's anything other than that, that should start raising flags immediately. Or the people that say, well, I'm coming to you because I heard seller finance will take people that a bank won't take. When that's just their generalized attitude on why they're going the seller finance route, that should raise a red flag, because you can't just give anybody a loan. And I correct people every single day that, yes, seller finance is more flexible than Fannie and Freddie lending, and it has more relaxed metrics, but it's still not the wild, wild west. So you can't just still screw all of your creditors and then just still go get your next one from seller finance and expect that they're going to be ignorant and give you another loan so you can burn them as well. Still doesn't work like that.
Now, if you do your underwriting and find that, like, there's kind of a problem here, like it's not a red light, but it's a yellow light. Maybe the credit score is bad, or there was some incident or whatever the case may be. Do you ever like come up with recommendations for like how to deal with that? Like it'll be okay, but just do this. Like
Absolutely.
ask for a bigger down payment or higher interest rate or shorter amortization. Like do you offer suggestions on how to get past that stuff?
Absolutely. Yeah, absolutely. Our job is to get as many of your files to clear the federal hurdle as possible, right? And so we don't even charge you the final 560 if we can't approve your borrower. So our business model is built so that we make more money when you make more money. And yet we're still highly motivated to make sure that we never pass anything on that could get you in trouble. We never pass anything on that, is going to be a violation. And so we employ ridiculous creativity to help your borrowers clear up their credit boo-boos and to establish alternative credit and to show credit worthiness, even if they've got nothing on their credit report that attests to their credit worthiness. One of the documents you'll find on our website is called Understanding Loan Conditions, and another one called the Alternative Credit List. And so we employ very creative techniques to take a file that on its face initially would be a no and write back to you and the borrower and say, if you can do this and go get us proof that you're making your utility payments on time and get a letter from your car insurance carrier stating that you haven't made a late payment in the last 12 months and get a letter from your landlord stating that you're paying your rent on time and that you have for the last year, we can balance out this black mark against you with all these compensating factors and we can get you across the finish line. We do that every single day. Or we might get back to you as a lender and say, hey, John, your borrower is $62 short of meeting residual income or meeting debt to income ratio. But I noticed you've got a 180-month term. If you're willing to bump that term up to 240 or 360, that'll do this for you. And now that'll drop your borrower in and your borrower will qualify. Or another alternative would be ask your borrower if he can come up with another 3,000 down. If we can lower your loan amount by 3,000, that'll put him over the edge. Or if your borrower will pay off this one credit card, we see he's got a $680 balance and he's making $75 a month payments. If that payment went away, he would meet the requirement. So what we do typically is we draft a range of options and then I get with you and I propose those options to you before I ever talk to the borrower, and you and I brainstorm on what option's best for you to get your borrower across the finish line, and then we propose those options to your borrower. So that's what we're in the business of doing, is turning yellow lights into green lights.
That's huge. I mean, that's a big deal. I mean,
because a bank won't do that. They're busy collecting low-hanging fruit hand over fist, right? Yeah. So it's easier for them to shut the door and go with the other 1,000 borrowers that have 850 credit scores. And in this market segment, that's what we're doing for you, is we're combing and sifting and helping you refine the nugget that the banks missed, because it's just too easy for them not to work with a 520 credit score when there's an 820 waiting for them.
I mean, I've seen this with a lot of attorneys, with a lot of bankers, where it's like they just kind of want it to fit this cookie cutter thing, and if it doesn't, it's just like no. Like they're great at throwing up obstacles, but like somebody who actually finds solutions, like that's where the value is.
Well, and when you think about it, it makes sense, right? Why would they? When they're sweeping up all the low-hanging fruit with two arms as fast as they can grab it, and churning out $7,000 and $8,000 loan origination fees for every single loan, and employing automated underwriting systems where they just put a piece of paper into a machine and push underwrite and it spits it out. Why would they slow down and do manual underwriting, which is tedious and time consuming? And so honestly, in the market share we're working in, that's why we're such a value to investors, is because we're doing something that the big people will not do. They're too busy collecting the easy cash. Yeah. Way too busy. Yeah.
And it takes some actual critical thinking to do that. I mean, to
it does.
really try to like see it from different angles and stuff. So
we spend weeks on every file for $679, and there's no big bank out there that will do that. No big
And I was
bank out
got,
there that will do
I
that.
think you just answered it for me, but is there an extra cost for these situations where you have to work hard to find solutions, or it's just the
Nope.
same amount?
Nope. I've got
Yeah.
files that we've had sitting on the pipeline for 3 months because the deal will fly if or when a borrower will get us back this document or this document showing they paid this little debt off or whatever. A bank would just close the file on you and walk away. We leave them open as long as the borrower and the investor are both still interested in seeing this deal close. I've had ones, I leave them on my pipeline for a year. And then finally, they get that one last document, and somebody will call me one day or email me and say, hey, we were supposed to get this credit card brought current and paid off last November. Here you go. We finally got it done. We don't even remember the file anymore. We'll have to go in and open the file and look it over and figure out what we were waiting on, and then put this thing together and finally put it out the door. So, yeah, no, we never give up on them if you or the borrower don't.
That's amazing.
As
That's
long
a
as
huge
they're
value.
motivated to make good,
Yeah, just say for the listeners out there, I mean, if you don't have a ton of experience in the lending banking world, I'm just telling you that's unusual to find somebody who is that hungry to make it work for you. It's very uncommon. So that's just want to point that out there.
Yeah, right. Exactly.
Yeah.